Happy Friday.
Hey, Rick. How you doing, buddy?
I was just thinking when I was rolling the intro, one of these Fridays we had to just go, how's it going, Pat? And you go, great. And I go, you got anything? You go, nope. Yeah, me neither. See you Monday. And then just log off.
Some days I feel like that.
You think, wow, there's nothing really there. But in this business, there's always something really there. It's just, if it's not in real estate, it's outside stuff that affects real estate. So do you like my new digs?
Yeah, I like it. Your new studio coming from it's in Hollywood, California, right?
Yeah. I moved. I'm right next to Jay Leno. So actually,
Studio.
I moved to North Central Phoenix. I used to live up here, and I got it's nice to have a designated spot for this. Where my other place, I'd move a desk, I'd bring the lights in, I'd set up the camera, and now it's just set. Don't have to worry about it, and I'm all ready for Monday. So Monday's going to be the first live update, and we're going to get ready to rock and roll from there. So today, 5,167 homes on a Friday, almost below 5,000 at one point this morning.
The saga continues. The saga continues.
Going into a weekend. Yeah. So the Cromford report is saying that sales are declining slightly, but when I do the 7-day moving average, I'm not seeing it. Now, he's got access to far better numbers than I am, and I think the declines in sales are probably just because, you can't find what you want.
No, I agree.
So I'll show you just real quick the 7-day moving here and see what I can pull up here. And show it to you right here. So this is what I do is I go over and, punch all these numbers in, right?
Mm-hmm.
So we had 3,891 new listings come up and 4,080 go under contract. So, but when I look at the chart, you can see the blue line here? Those are new listings that are coming up, we are trending up the past few weeks in listings coming up and listings being put under contract. The challenge is the ones that are put under contract are exceeding the listings coming up. So it's not like people aren't putting their homes on the market. It's just they're getting gobbled up still at a rate of over 200 homes more than what's coming up. And so that makes it kind of tricky. And then there's this is rent, average rent per square foot. Chart really spikes up, but really when you look at it, we were $1.10 per square foot. Now we're $1.17. So, it's a steady climb upwards. And if you look here in 2008, rent did decline from 8 to 10 on the price per square foot. And then it just hobbled along. In 2014, it took off like a rocket. And that was from the Cromford report. And we have a CMI, the Cromford Market Index, which is simply a measurement of supply versus demand. Anything at 100 is normal. We go over this all the time. The total CMI for our market is 486. That's how out of whack it is. And Robert Orr said it needs to be 90 for prices to start falling.
And what is it at?
486. That's not going to happen anytime soon.
No.
So the only thing that's going to make that go down to 90 is some kind of shock to the system. The normal market forces are not going to pull us down to 90 anytime soon. So it's got to be something that just a credit freeze, a banking crisis, and as if the pandemic wasn't enough of a shock.
Yeah.
Which we thought it was going to be. But it's to get it from 486 to 90. I mean, I don't know what it can be now. I was a little nervous last week over the Robinhood saga just because that clearinghouse said that they kind of had, the hedge fund was about to go bankrupt and they didn't have enough money to cover, because they have to cover for a 2 or 3 day spread, right?
Mm-hmm. Yeah.
So trading almost froze, didn't it?
There was. I mean, there was a lot of. I mean, I don't say. Well, they froze it because they stopped trading.
Yeah,
So,
and if they hadn't have done that, I mean, the clearinghouse didn't have enough money to cover all the shorts, because they have to cover it temporarily for like 2 days.
Yeah. No, I think there's something going on there that is somewhat unsettling, but I find it hard. I mean, this is just my personal opinion. I find it hard to believe that a number of smaller investors can overcome these billion-dollar hedge funds.
You got to cheer them on a little bit, because they saw they're kind of like, well, they've got all this money, and I'm little Joe Blow down here, and I can't seem to do it. I'm just going to get some help. We're going to go in and do it together. And, hats off to them. Now these hedge funds kind of realize that they need to start playing fair. And we have a comment here from Chris. How was the 55 plus communities? Chris, I'm glad you asked that question. It's not the knockdown drag out fight that we see everywhere else. Believe it or not, we got an offer accepted, and they contributed towards closing costs, which is unusual because our seller paid closing costs right now, total in the market's only 7.1% of homes sold are contributing towards closing costs. And usually people are saying, well, I'll give you 505 if you give me 5 back. So it's, you know what I mean?
Mm-hmm.
So
something just popped in my head. I mean, in terms of the 55 plus communities, I mean, do you think it might have something to do with the demographic as far as, let's say you're 60, 55, 60, do you really want to be put through that? I think they're a little bit more calm from a demographic standpoint. They don't want to have 20 or 30 offers thrown at them.
Well, I think it's, if I look at Sun Lakes, normally this time of year, we have 125 listings. And let me check right now and see what we have. Cause, the snowbird traffic is down, and that's your buyers.
Yeah.
So that's one factor.
That's one factor, definitely.
So if we were to, I didn't pull up a Cromford index on, their inventory is pretty bleak. 29 homes, but that's just Sun Lakes, but there's a lot more over 55 areas, but, there's not, in some cases they're getting multiple offers, but it's not crazy like the general market. If you're 350 to 400,000, you're looking at booked all day, all weekend, people looking at it and reviewing multiple offers on Monday, or they just take the highest one the first day and wipe their hands.
Are you talking about non-55?
No, non over 55. But
I think once you say that, that kind of goes back to, like I said, what I was saying about the demographic. You're 55 or 60, you don't want this craziness. You don't want 20 or 30. You think maybe it's a function of the seller saying, hey,
Well, I think they want the most that they can get, but I believe that, like you, that there's a portion there that says, just get a good price and just be done with it.
Yeah.
And the buyers are not in the mood for those kind of antics either.
No, exactly. That's kind of what I mean. They're both not.
The 2020 census showed that 35% of our buyers were over 55 and were retiring in Arizona. And so that was, that's a considerable number, the number of people that are coming in here. And but it hasn't made this big. I guess there's a difference between, we used to call it the Cromford index that came across at like 150 as frenzied, and now we're 485. What word would we use for that?
I know.
So I would say that the over 55 group they're like almost frenzied, but not quite.
Yeah.
So it's a little easier on the search. And I've got clients coming down that you're working with right now that are looking at over 55 in March. I got one under contract now. It's going to close March 1st. And, so far what we saw, we didn't have tons of people, knocking on our door, and we were competing. And Chris is asking, is it better on the west side than the east side? Better prices? Yes. Is the frantic activity less? No. There's just more inventory out there. There's more homes available on the west side in certain price ranges.
Well, I think too, they've been expanding. They've been doing, I don't know the exact number, but it seems like they're doing a little bit more home building. They've been pushing out that way.
Yeah, there's definitely a lot more home construction. I mean, you got to go way out west, Surprise, Buckeye, and
Verado.
East Mesa. Yeah, Verado. Yeah. And they're still experiencing delay because of supply side, supply line issues, getting lumber, getting anything, even nails. You got to figure that with the pandemic, companies that supply, like try buying a refrigerator right now, it takes 3 weeks to get delivered. And so lumber, everything used to build a house, somehow is getting the glass for the shower. You know what I mean?
Mm-hmm.
Tile, everything's delayed. And I wouldn't want to be a builder right now. But on the west side, that's what in California we used to call drive till you qualify. You just keep going out, you end up in Moreno Valley. That's a nice house, but I'm 3 hours from the office.
Yeah.
So
the east side is, I don't know, from a demographic standpoint, you get the 30, 35, 40-year-old, the Intel engineers, because we have a little bit more technology down here in the East Valley. You got Intel, you got General Dynamics, you got some satellite companies that the west side doesn't. West side's got the warehouses. They got different. It's a different makeup of employers too.
Yeah, there's a higher income of buyers definitely on the east side, especially with everything that's going on in Chandler with Intel and Orbital Sciences and everything. So
yeah. So that's going to draw that crowd, a different crowd.
Yes, I want to remind everybody on Monday morning, going to start a morning podcast where we're going to get up. And we're going to actually look at the numbers together. So that's what I'm going to reserve my weekday mornings for. Is you get on and you have a question, you say, look, I want to look at the west side. I want to look at prices between 300 and 400 or 200 and 300. We'll do that together and show you what's going on, and then talk about the numbers as we see, because we never know on Monday morning what to expect. Now, I read on the what's the name of that site you share with me there? The
Mortgage News Daily.
Yeah, Mortgage News Daily. One of the guys said rates bounced all over the place this week, but you wouldn't notice it unless you were looking at it under a microscope like they do.
Yeah, or like I do. Yeah, I mean they've been creeping up a little bit. I mean, like I said, day to day, people could open up a paper on Monday and see the rates are at, say, 2 3/4, 2 5/8, 2 3/4. Rates for refinances are about an eighth higher typically than a purchase, because they've got that half a point built in pricing for the refis now that they add in December. So you can't, the average Joe will definitely say, what's your rate? Well, are you refinancing or purchasing? Because the rate's a little bit different, but they have been moving around. I mean, right now it's 2 3/4, 2 7/8. Your intraday movements are going to be not the note rate that you're going to get on your mortgage, but basically the cost. As I have told you before, that on Monday I might quote 2 3/4 for a gentleman with a cost of $1,000, but if rates go down a little bit, I'm still going to quote 2 3/4, but maybe that $1,000 disappears and goes down to 200 or 100. So that's the kind of there's a subset of rates, the rate itself, and then the costs. The costs are going to be the ones that fluctuate Monday, Tuesday, Wednesday, Thursday, up or down a little bit. And this is the note rate for the mortgage, but that's where you're going to see the cost 2 3/4 $1,000, but then rates go down. that 1,000 goes down to say 0, so that your cost goes down. That's what really fluctuates day to day.
Well, that's nice that the rate's not bouncing around. The flex is in the contributions. So
Yeah.
I don't think a lot of people don't see that. Well, I know they don't see that, but I saw something else yesterday that it was explained on it was on a video I was watching. It was explained how central banks provide this liquidity, right? And the Treasury has a spending account, let's say a checking account that's actually held by the Federal Reserve. And because it's like you and I, we have a checking account at Wells Fargo. Okay.
Mm-hmm.
And the Fed is been, loaning them the money. And the Fed Chairman Powell came out and says, guys, you guys need to start getting this money into the economy. It doesn't do any good sitting in your Wells Fargo checking account. If I went out and borrowed $50,000 and I just logged in and looked at it every day, that doesn't help anybody. And so that Chairman Powell's been shouting from the rooftops when Trump was president and now Biden saying, guys, you got to get this out. Well, it's coming. They are going to take that 1.9 billion, 1.6 trillion, and it's going to hit the market. The last time they did that in March, everything went up, started to go, gold went up, Bitcoin, everything really took off. So it's going to be really interesting to see what happens as 1.9 trillion hits the market. And I haven't seen the details of the plan. So if it's 1.9 trillion that goes towards infrastructure, so I really don't know what Biden's plan is with this money. And if it just goes to like state assistance, I don't really see that, giving a big goose to, to local economies. Is more like keeping people afloat per se. But if there's enough money in there that's going to circulate, M2 velocity, the money gets spent.
Mm-hmm.
That may affect rates. And this video I was watching, this gentleman was saying, look at this 1.9 goes in. And if it takes off like a rocket, we could see rates on their way up.
Yeah.
Could get
the way rates have been, there's so many dynamics that are going on with the Treasury, the treasuries, as far as issuing and the government sending out checks. Like I said, this COVID has really changed a lot of economics behind the whole scene. I mean, they're issuing $1.9 trillion. I mean, it's just mind blowing. I mean, our debt's 29 trillion. It's almost like they're saying we're not going to worry about that. We're just going to. But I don't know about the 1.9 trillion. They said they're going to get money to California and New York, and just to try to shore up some of these local governments. How much money is really going to go into the economy?
Yeah, what's left after you bail those yahoos out, right? So
yeah, I mean, so rates. I think the biggest shock, obviously, we're going to see next 6 to 8 months is rates going up. I mean, people have been comfortable in the 2.5 to 2 7/8 range, under 3. If they do go up to say 4.5, that really rates probably should be. We've been just in a luxury zone here with rates 2.5 to under 3%. It's ridiculous. Low 2s, for VA.
Yeah, I'd like to put together a sheet that shows here's a rate and here's the payment and here's the price of the home, right? And it'd be a lot of work to go. Now the rate went up to this. What's the payment? Oh, wait, the house just went down 5%. But you know what I mean? Bump, 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 bump. There may be this, the payment may stay the same. The house price goes down, the rate goes up, so
that's what's gonna eventually happen. That's been happening the last several years. Like back in 2018, we saw rates shoot up, from mid 3s to low 5s, and we saw a slowdown in the housing market.
Yeah, that was the taper tantrum, right? So
yeah, exactly.
Yeah. So MDA Medical says, I think we just missed the closing credits. Closing credits that we're offering. Well, if you've already purchased, yes. If you haven't purchased yet, just to get we're offering up to $1,200 in closing cost credits. Anything over 400,000, I'm offering $800 in closing cost credits, and Pat is offering a $400 appraisal credit. Under 400,000, it's $500 and 400. So, yeah, we snuck that a little too late, I guess. So,
And then, that also, but that's basically would be money out of my pocket. But obviously if people buy, I've gone over people, you and I have worked with clients that I said, hey, if I can go from 2 and 5/8 up to 2 and 7/8, once again, I've expressed this a couple of times, maybe on some of these, YouTube, these videos, but it's amazing what kind of, people need to spend some time, like I said, when they call into a call center, and I've stressed this to you, and when they call into, and I'm going to repeat myself, for bear with me, but when they call into a call center, a big company, they don't give them options as far as, well, this is your rate, this is going to be your cost at this rate. They just basically spit out a rate, and then they send them a loan estimate with 2 points discount, and that's what really frustrates me as a mortgage, individual mortgage guy, is that these call centers, they don't really put a lot of thought into pricing the loan, because I might be able to quote you 2 3/4. Let's say 2 and 5/8 is the par rate, but if I bump up your rate to 2 3/4, I might be able to give you a $2,500 credit in closing costs.
yeah.
And it's real simple. It's a real simple equation, but I think people should be offered that option. What's this cost at this rate, or this rate, or this rate, or this rate? When you call a call center, it's like, here it is, and good luck. And that's I think people should spend more time. You really don't, to shop rates sometimes is a waste of time, because for the most part, if you got a competitive mortgage guy, they're not going to be that far off. You're not going to have 3 people quoting you 2.5, and then one guy quotes you 4.5. It's always going to be all in the same thing. But you can really make a big difference if you spend some time saying, hey, what's my cost at 2.5 versus 2 and 5/8? And my job, I think, is to look at the whole, the deal, and say, I think your best rate today, if we were locked today, is X. And I can run the numbers and say, hey, if we go down to 2.5, you're only saving $17 a month, but I can give you $3,000 in credit if we just keep it here, which is a big deal. 3,000 divided by, so that it's between,
well, yeah, and then you tack on an additional 800, and so we can do a great deal of work getting you some relief on closing costs. So,
yep.
But so what's this? If more money floods the market, assets to become more expensive, wouldn't that mean rates would become lower, just as it happened last year? I think the short answer is no.
Yeah. I mean, the rates, there's a lot of function to the rates. What I've seen what we saw the last 8-9 months is there was a disconnect back in March and April, because remember, I was telling you that mortgage rates technically should have been, in a free flowing market. We saw rates, obviously, the low to mid 2%, to say the mid 2% range, but technically there was a disconnect between the mortgage-backed security market and the treasury market. And the lenders, when they get flooded, rates should be lower, but they're basically, they use rates to adjust their business model, their flow of business, because if they've got 1,000 loans that they can't get done, and they lower rates even further, they're going to get another 1,000 loans that they can't get done. It's going to take them 6 months to get through those loans. So the mortgage lenders, and what the public doesn't understand is that they do use rates on a daily basis. And I get emails on a daily basis saying, hey, we've adjusted our rates. We're getting caught. I get these emails from lenders saying, we're caught up. We're going to adjust our pricing here this next week to be a little bit more in line with the market. So if a lender gets bombarded with loans, they'll bump their rates up a quarter. They'll kind of take themselves out of the market to get caught up. And that's what's been happening the last 8-9 months.
Yeah. And if the economy, the thing that'll make rates go up will be a robust economy, because the Feds want to put the brakes on. But, Chairman Powell has said that he wants inflation. And, they want inflation, but the central banks have not been able to create inflation. Historically, they haven't created. Historically, they've stopped inflation by putting the brakes on and raising interest rates, but they have no data that shows that they've been able to create it. Yeah. So it's spending from the Treasury that creates inflation. Too much money chasing too few goods. So it's not the Fed. So the Fed just has money that they put in reserves for the banks to lend. And there's a whole bunch of mud in between that, between the Fed laying it out on your kitchen table to the Treasury and the Treasury spending it. So it's a real dance.
Yeah, it really is a real dance. It's almost like they're taking a dump truck of water and dumping it into Lake Michigan. Is it really going to have much of a effect? It's not. That's what it seems like. It's just like, God, they could put 1,000 dump trucks of water, dump it into Lake Michigan. And it's like, all right, what changed? We
have examples all around the world too. Cause you look, Japan has been spending like crazy for decades now, and they still don't have inflation. They still have deflation. And you compare their charts with our charts, and they're almost similar, except the amount of money that's starting to circulate in the economy right now is finally starting to have a trajectory. But, they've been borrowing, and it hasn't resulted in inflation. And same with Europe. You look at Germany. Germany is, in England, they're at negative rates. But the difference that Germany did versus the United States was they gave an awful lot of incentives and incentives for like millennials and the generation behind them in infrastructure projects and job skills that got that generation prepared. And so that money was spent to propel them into new careers. The United States just can't seem to do that. I would love that if we're going to spend this much money, fix the damn roads.
Yeah. Yeah.
Particularly in Arizona, we had rubberized asphalt, and I think we had and it was beautiful when we first got it. You didn't even hear your car just now we've got the worst roads on the planet because it all crumbled up. But if you're going to spend 1.9 trillion, fix the roads. That puts people to work, start repairing bridges, these patching. And now I heard today our fuel prices since the new administration got on have increased 35% already.
Nice.
There goes my truck. So,
well, speaking to jump around, me, just a thought that came to my head. One thing that's frustrating, I know we're kind of just, well, you said we just talk, but, you hear Biden talking about this $15,000 housing credit, for people, first-time home buyers. That's a joke. That's a joke.
I can't think of a worse way to make people not afford housing.
It's a joke because right now in this market, that's how much disconnected these guys are in Washington about, that what's frustrating. You and I really try hard to bring the truth to people, an individual client, I try to just give them the truth, because there's a lot of, I say we're drowning in, what's my saying is we're drowning in information and we're starving for wisdom. And, what's frustrating is, they're throwing this $15,000 credit, like, oh, we're going to give you $15,000 for first-time home buyer. First-time home buyers don't even have a chance in this market right now. When you got
even with 15,000, they won't get a chance. And the other hidden fact is they've done an excellent job of saving their money. They have the money, as a rule for the most in that generation.
Well, the younger generation.
Yeah, they've saved the money. And
I've been really impressed with a lot of these, the last year, the people that I've worked with. They've done a damn good job of really being economically diligent in terms of, getting ready, set. The problem is they've got money, but now they're getting pushed out because the offers are getting 20, 30, 40,000 above offer price. So what is this $15,000 credit or this, credit going to do for home buyers? It's just frustrating because it's fake.
It shows you care.
Huh?
It shows you care.
It ain't gonna have any results.
Reminds me of Arizona. So here's one that puzzled me a while back. Remember the credit that you could get? You could get a license plate in Arizona. It was a blue license plate if you had a energy
Electric car.
friendly car, right?
Yeah.
And you got these tremendous rebates from the state. You could go buy a truck that,
Mhm.
and you'd get like, $15,000 tax credit. And the goal was to lower emissions in the state. But then they had to stop the program because they ran out of money. So my first thought was, well, you wanted to lower emissions. Did anybody put a pen to it and say, well, how much money do we have to give away to even affect
No.
emissions? So
Idiots.
they did it to make it felt good. And as soon as so many people started participating in the program, they killed it. With
Yeah.
the Biden plans for the $15,000, that might really light up Nebraska or Iowa or North Dakota, where home sales aren't quite that brisk. But in a bidding war, that 15,000 is not going to do anything for you.
No.
It's not going to help you. You come to me in Arizona right now and go, I got a grant to go get a house and I want something for 250,000. I'm gonna look at, okay.
It's like giving keys to giving keys to a car to somebody and saying, "Here's the keys to the car. You can have it, but oh, by the way, there's no gas in the car.
Yeah.
You can't drive it." I mean, that's the same thing.
The other thing I saw the other day, and this is what I wanted to ask you. Remember when we had the housing crisis in 2008? Who could forget, right? You were hearing a lot of comments about mark to market. In other words, instead of all these foreclosures, like if the market were to go down now, because we're like in the third or fourth phase of economic distresses where the central bank has had to come in and bail out banks and bail out, and they wanted to go mark to market. In other words, let's say I bought a house for $500,000 and we have a huge financial crisis, and now my $500,000 house is worth $350,000, but I have a $450,000 note on it. Mark to market, rewrite your note at 350,000.
Yeah, basically, you're adjusting the value of the asset to basically reflect like the current market conditions.
Yeah, and I think that's probably what we're going to see happen someday if we end up with another wave of the financial system getting in big trouble. Right? They're going to say, all right, let's just go mark to market instead of throwing all these people out of their homes.
Yeah, I mean it's obviously an accounting gimmick, basically.
Yeah, well, nobody better at accounting gimmicks than the feds.
Yeah. But rates overall, rates have been, steady. Nothing on the mortgage news market. Obviously the job numbers came out. Some people were saying are obviously disappointing because they revised last month. So, they come out with numbers and they revised the previous month, so it looked like it was negative. I mean, the unemployment went down because people got out of the market. I think I'm seeing first time home buyers. I could just talking to a handful of people this last week or two. I mean, it's you can tell that they're chomping at the bit, but they're frustrated because they can't find anything. And I've had a couple of people, one person say, I'm just gonna sit this out for a while.
I think that's what you're saying, and it's unfortunate because I've got so many buyers out there that are looking for something specific, and and I dig and I scratch, and I went through the coming soon listings this morning. I can't even find anything there. So I don't think agents really even understand the whole coming soon listing saga on the MLS, and they're putting them on there as coming soon and they're already listed. Give me a break.
Yeah.
So, so it's coming soon. And I look and it's, wait, it's been already on the market for 2 days. So, it takes them a while to figure out how to do this, I guess. So it's I think buyers are backing off for that reason. Screw it, I'm out. But on my 7-day moving average, not seeing that yet. Like I say, the Cromford market, Michael Orr's got better numbers to look at than I can see. He goes in and pulls them directly from the county. But I think next week's going to be more of the same. But I think as we go into month 1 and 2, watching the impact of this stimulus money coming out and what does it mean, and is it going to take certain sectors of the economy and make them bust? Unfortunately, it's already happening in real estate and stocks. So, are there any other tricks up to their sleeve that, you're not going to help the restaurant industry if you keep them closed? The malls are not going to spring back like crazy. They're a morgue. So I really don't know what's going to happen. Don't mean to be doom and gloom, but I think let's look at the numbers to see what's going on. In the meantime, people are moving here like there's no tomorrow.
I know. It's just people are tired of California. I mean, I feel, I tell our viewers, our millions of viewers, I mean, don't get bored watching us because, we've been watching, probably saying the same thing for the last couple of months, but I almost feel like we're sitting in a deer blind waiting for something to happen and waiting for that buck to come out of the woods. It's like we're sitting there. And, I think, like I said, this is a good exercise. We're keeping an eye on it week by week, watching the numbers. I mean, if something drastic happens, we're going to be, we're like I mentioned a couple of weeks ago, we're going to be, I feel confident we're going to be, you're going to say, hey, this is what happened this week. The last 2 weeks, all of a sudden we got a trend going.
Yeah, I'd love to log on and see listings all of a sudden be at 7,000.
Yeah.
And then like the next week, 10,000. Okay, here we go. Normal is coming. That's what I'm waiting for. I can't stand this bidding war market. I hate it.
It's frustrating.
So
but, I think people have to kind of be, think outside the box, be patient. I mean, if they, maybe you won't find the perfect house, but, maybe you got to be patient and you got to be creative. Maybe, you just find a house that, like you had said before last year, a lot of these people want a house that is picture perfect ready for them to move in. And, you got to think outside the box of this type of time frame because we're in such this small box right now. You got to maybe think outside some way, shape, or form. Like you said, the coming soon, catching a listing, beyond, be the first to go there, or find a house that might need a little more work and get like a rehab loan.
Yeah, don't be afraid of that house with the pink bedrooms and the purple rec room. I mean, and tons of wallpaper because nobody else is going to want it. And you can do well with that. Don't be afraid to earn your own sweat equity. If you look at some of the homes on the market that are sitting there, it's the cosmetics that are keeping them. And then we're running into some repair issues. I mean, roofs that need new underlayment, some plumbing issues and the outside needs paint. Well, you can still do that,
Yeah,
and
I think
so.
Don't throw the baby out with the bathwater because I think you've come across some people as like, hey, you get some people that just get stuck on one issue and like you got to step back and look at the whole picture. If you got under contract, you've got an issue. You're like, okay, what if I lose this house? What's my alternative option?
Yeah.
Some of these people, been out there looking for a year. And like you said, that's where I think common sense and just thinking things through and not using your emotion to overcome during the purchase because we're in just a weird time frame. And you got to be smart and think about it. Like, okay, we've been looking for 8 months. We like this house, but they're wanting us to do this or they don't want to do this on the repair, what's my opportunity cost if we don't agree to this price or agree to these repairs or not to do them or whatever, whether you're a buyer or seller, what's my opportunity cost to go out and look for another house?
Yeah.
Be smart. I think you got to be smart about it.
It's a challenge. So I'm again, just want to remind people before we check off here, we're going to be doing this live every weekday at 8:30. And if you can't make it, it will be uploaded. It'll be saved and uploaded so you can see what we talk about. So, but the live gang, we're going to be kind of having some fun and just dancing around, looking at the data together. They probably won't be much longer than 30 minutes, if that. But I'll stay on as long as people have questions. So should be fun, and I'm looking forward to it. And Pat, you going to go out and ride your bike this weekend?
Yeah, take the Harley out. Yep.
Yeah, sounds like a party. So, all right. We'll have a super time. Enjoy the Super Bowl.
Yeah. Go Packers.
and pretend there's a lot of fans there.
I'm gonna pretend the Packers are playing.
Okay. All right.
All right.
See
All
you
right, buddy.
later.
Your
Bye.
viewers. Bye.